This Saturday, we have 3 interesting webinars for you. Morning 10 a.m., we have Mid and Small Cap Mutual Funds Navigating Underperformance and Value Traps by Akash. At 10 a.m., we also have another webinar, Precious Metals Time to Shine or Lacking Lustre by Samyuktha. At 11 a.m., we have Insurance Impact of GST in Health and Term Insurance, Right Time to Take Insurance by Abhirami. What are you waiting for? Register now.
Friends, in this video, I'm going to talk to you on the topic, the winning investors formulae. As an advisor or as a portfolio manager, we come across so many investors, we work closely with many people. The intent of a professional is to always see all his investors win. But not all investors win despite buying the same products or investing in the same advice. Why does this happen? Interestingly, it is very easy for me to say that this is an advisory problem. While it is the responsibility of the advisor or manager to create returns, more often than not, it is the investor who actually plays the most critical role. I am not trying to extend the responsibility of the advisor or the manager. We are fully responsible, but some situations warrant the investor to actually do a few things right. Many situations, it is the investor who creates the atmosphere for the outcomes. What do I mean by this? It's actually very simple. Markets keep going up and down. Sometimes investors start on a market high and then see the market going down. In such situations, the advisor or the manager would have already taken decisions when the markets were high. The money would have been invested. The investor would be seeing a small notional loss in his portfolio. In such a situation, what can change things dramatically? Here is what I think has done it time and again for investors. It is not the genius of the advisor or the manager. We have to be humble enough to admit it. It is actually the investor who takes charge in such situations. He listens to what the advisor has to say in that situation and shows confidence and commitment to his investing. What does he do by that? He makes another small commitment, maybe 10 to 20% of his existing investment. He deploys that money at a time when the markets are not in his favor, the portfolio is not performing, and he is seeing a negative at that time. But showing conviction and commitment to his portfolio at that point in time gives the advisor and manager another opportunity to buy into better parts of the market at even more favorable valuations. This has happened time and again, and the investors who took this line of response, took this as their priority, have done much better than investors who have watched and waited through every crisis. I have not seen investors who have invested in every correction do badly at all, because they have always invested more money into better parts of the market. Also, these investors are not the kind to waste their time on trivia. While asking questions is important to every investor, asking the right questions has made a great difference to these investors. For example, when the market has fallen, you know the portfolio is down. So, at that point in time, should you ask, why is my portfolio down, or ask, what should I do at this time to make my portfolio come back faster when the markets go up? So, these are two questions. Most investors choose one question, but the discerning and the smarter and more successful investor ask the better question. And then they satisfy themselves with the answers. If they are not satisfied with the answers, they probe further and get better clarity through clarification, and then they proceed. So, it is not as if an investor is expected to blindly trust what the advisor or the manager says, but to understand what is the thought process, How well is the advisor or manager prepared to take him forward to a better place? What is the strategy that is being done in an hour where opportunities are better? Are we going to be better off making decisions now given that valuations are in favor? These are questions which give investor the confidence and conviction to make investments when valuations are more in his favor. Asking these questions has made investors far more successful. Not only that, it makes advisors and managers look better performers. Actually, one should have the humility to accept that bringing out the best in an investor is going to bring out the best in a manager. Manager or advisor is responsible to bring out the best in an investor, but that is a shared responsibility. The investor also has to reciprocate his share, his commitment and his conviction, and when he commits, when he becomes convinced and when he acts in a timely way, the advisor or the manager on one side and the investor on the other side collaborate to create success even in the worst of times. So it doesn't matter whether the markets are down and out, or if there is no hope left, or it's a time when there is a lot of fear. If you can bring this collaboration to work successfully at that time, then magic will happen in the portfolio. I say this in a generic way with the belief that advisors and managers will be hardworking and the investors will be trusting. This is the formula which will make every investor more successful than the average investor, and this is the formula that will take investors on a greater and a better plane towards success. So the entire trajectory of investing gets elevated and you start moving up towards a better place in a much faster way. Whether you started at the right time or not hardly matters, but what you do when you are presented with the crisis is very, very critical. Asking the right questions, creating the right conviction and committing money in a timely way is going to be what will make you one of the successful investors whom others will look up to and your advisors and managers will greatly respect. Thank you for watching this video.